Welcome back. This morning, the inflation report was released, specifically regarding personal consumption expenditures (PCE), which rose 0.3% on a month-over-month basis versus the prior number of 0.6%. All the numbers today were a little bit weaker than last month. Year over year, PCE rose 5% versus 5.3%. Core PCE, which excludes food and energy, which are considered to be the more volatile components of the inflation report, month over month increased 0.3% versus a prior 0.5. Core PCE year over year 4.6 versus 4.7. The declines are attributed in part due to the declining energy prices, food prices. Energy prices actually fell, food prices rose, as well as goods and services. So the energy prices are really at the core of the declining PCE. Now, taking a look really quickly, the difference between the PCE, personal consumption expenditure, and CPI, the Consumer Price Index, there's a couple different very significant differences. One of them is that the CPI does not take into consideration employer-provided medical insurance, Medicare, Medicaid, things like that. PCE does. So when CPI goes up more than PCE, it indicates that these government services aren't keeping pace and that the private sector is bearing the brunt of the inflationary burdens. Also, the PCE, which is what we're looking at today, measures the change in prices of goods and services bought by households and also by purchases made by the government on behalf of households. The PCE is also considered to take into consideration substitution. So if we can't afford a more expensive car, then we'll buy a less expensive car, and the PCE adjusts for that. Now, taking a look at the PCE, which is the blue line here, and the red vertical lines over here are the core PC. Now, core PC excludes food and energy. So when the blue line was below the top of the red histogram bars here, it shows us that food and energy prices were weak. But since then, they've come back to the upside. We can see this real acceleration over the past year or so. That is as a result of the very high prices for food and energy, but it looks like that's starting to wane a little bit. I don't know if it's the beginning of a new trend, but what was the strongest part of inflation, food and energy, that looks like it's starting to drop a little bit. Now, again, we take a look at CPI versus PCE. CPI is the blue area chart. PCE is the yellow area chart below. So we can see that CPI has been significantly has been stronger, has been higher than PCE as a result in part of food and energy, but also because the private sector has bared the brunt of these inflationary pressures. Now, the red line represents the comparison between the two, the CPI divided by the PCE. And we see that is really trending to the upside. If we were to see a reversal, I think it would indicate that there's a more of an equal distribution of inflation across the entire economy. But in my opinion, at least, I think that the red line represents more the inflation that's bared by the private sector and not so much by the government sector. Now we take a look at CPI versus PPI. And this was not reported today, but I think it's important just to take a quick snapshot. The blue area chart here is CPI, that's Consumer Price Index. The green area chart is PPI, the Producer Price Index. Those are the prices that are paid for by the producer, the wholesale level. And it's thought that if prices go up for the producers, they'll eventually pass on those higher prices to the consumers. So there might be a little bit of a lagging effect. And the red line represents the difference, or the comparison, I should say, between CPI and PPI. So that when the red line is going up, it means the consumer is spending more, relatively speaking, than the producer. But when the red line is going down, it means prices are going up for the producer. Prices did go up a lot for the producer 2020, 2021, but the red line looks to be trending a little bit back to the upside, which means maybe finally those higher prices paid for by the producer to buy those wholesale goods that is now being laid on to the consumer, and those prices are going to go up. And a quick snapshot back to the 1970s and 80s, just to give us a snapshot of what inflation looked like, because we all talk about the 70s and 80s as being this historic period of time with tremendous amount of inflation. The area chart in the background shows us the standard CPI. The purple line shows us core CPI that excludes food and energy. So excluding food and energy, I think that's really the difference, is that we say, well, energy prices were very strong in the 1970s, but that really kind of fell apart. And I think that's really the difference, is that food and energy, I think, seem to be leading the inflationary charge so far in our current economic climate. Whereas in the 1980s, this red line was energy. All of a sudden, energy prices really plummeted. And food prices, which are the green line, well, that kind of stayed that remained at the higher end of the inflationary number. That's really the difference here between present day and the 70s and 80s. In the 70s, obviously, we know we had a massive acceleration of energy prices, but then that really fell apart. Now, yesterday we took a look at GDP, which looks to be trending to the upside, and it has a very strong correlation to the stock market. However, yesterday we spoke about the fact there's a massive divergence. Stocks have been very weak despite a growing GDP number. So we said, well, if GDP is growing, what else could be really weighing heavily on stocks? One of those factors is very high inflation. Well, maybe today's report is a little bit of good news. Maybe if those energy prices, which were some of the strongest parts of our inflation that we've seen over the past year, if that starts to wane, maybe that will bode well for stocks and take a little bit of weight off of the top of the stock markets. Next week, we have the jobs numbers, non-farm payrolls, which is the other very, very big component that goes into the decision by the Federal Reserve whether to raise or lower interest rates. So next week will be very interesting, and we'll be sure to update you with any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.